The global financial system is currently handing an absolute intelligence test to retail investors, and the vast majority of participants are failing it with flying colors because they choose to chase complex illusions over boring realities. If you cannot explain your current asset allocation strategy to a 12-year-old child without relying on dense corporate jargon or hyperactive macroeconomic theories, you are not actually investing. You are just a glorified gambler who is waiting for the market to hand you an incredibly painful lesson. Right now, the largest institutional players on Wall Street are quietly circulating internal research papers detailing a permanent structural break in global debt markets, a warning they would never dream of dropping into the public news cycle because their business model relies entirely on you staying emotional, panicking, and liquidating your assets at the absolute bottom of the cycle. The absolute reality of wealth creation is that a flat, dull, unshakable discipline will outperform any high IQ active trading strategy every single day of the week. Yet the average person continues to treat the stock market like a casino instead of a long-term capital compounding machine. We have officially crossed a massive macroeconomic line where the 30-year U.S. Treasury yield has breached the 5% mark, a specific technical breakdown that historically signals that institutional big money is demanding a massive premium because they smell systemic sovereign risk. When the risk-free rate of return climbs this high, it acts like a giant gravity well for the entire financial universe, dragging down the valuations of speculative growth companies, tightening corporate credit lines, and making your favorite overhyped technology stocks look absurdly expensive. Relative to cash, the crowd is currently looking at their nominal brokerage balances and feeling incredibly wealthy based on paper gains. But they completely fail to realize that this entire market expansion has been driven by a laughably small handful of semiconductor and artificial intelligence mega-cap companies. When the top 10 largest corporate entities in an index are responsible for over 70% of the entire market performance, you do not have a healthy, sustainable economic expansion. You have a highly concentrated, top-heavy bubble that can snap back violently the exact second the narrative shifts. It is the exact same structural pattern we observed during the peak of the dot-com bubble in late 1999 and right before the catastrophic real estate collapse of 2008. Yet the average retail participant behaves as if history has been completely erased by the Federal Reserve. The second major indicator that the mainstream media is completely misinterpreting is the structural persistence of core inflation. Specifically, the massive divergence between consumer-facing price indexes and the actual underlying producer manufacturing costs. When producer prices are consistently running hot, those elevated input costs inevitably bleed directly down into the retail consumer market, forcing the central banking system to maintain higher interest rates for a significantly longer duration than the market has currently priced into equities. Higher borrowing costs are an absolute poison for highly leveraged businesses, and as consumer discretionary spending gets squeezed by rising costs for baseline necessities like insurance, energy, and rent, corporate profit margins will inevitably face a severe contraction. The financial institutions refer to this extreme divergence between a rising stock market and a deteriorating bond market as the alligator jaws, a highly visual phenomenon where the gap between asset pricing and macroeconomic reality stretches to its absolute historical limits. The fundamental rule of global financial markets is that these alligator jaws always close eventually, and historically, they do not close by the bond market magically recovering. They close by the stock market experiencing a rapid, unceremonious downward repricing. Most people will watch this structural setup unfold. They will do absolutely nothing to prepare their liquidity, and then they will completely lose their minds and liquidate their portfolios for a massive loss the exact moment the market experiences a routine 30% correction. The truly lazy, highly conscious investor does not stress over the precise day or week that this correction begins, because trying to perfectly time a market top is a completely stressful waste of your limited daily cognitive energy. Instead of staring at charting software and panicking over daily price fluctuations, you should be sitting back on a beach or a patio, completely detached from the daily noise, waiting patiently for automated liquidations to create generationally cheap entry points. Every single major market dislocation in human history creates a brief, highly predictable window where high-quality corporate enterprises with pristine balance sheets are dumped into the market at absolute fire sale bankruptcy valuations. During the forced liquidations of 2008 and the sudden systemic shutdown of 2020, high-quality material producers and critical infrastructure businesses dropped 70% from their highs because institutional funds were forced to raise cash. When mutual funds and highly leveraged hedge funds face massive margin calls, they do not sell the toxic assets that they want to get rid of. They are legally forced to sell their most liquid, high-quality positions just to keep the lights on. That specific moment of systemic forced selling is the absolute golden hour for the disciplined investor, because you are able to step in and acquire world-class cash-generating businesses for pennies on the dollar, while the rest of the world is crying on television. To successfully execute this without letting emotion ruin your execution, you need a completely rigid, automated four-step framework that eliminates human decision-making from the equation entirely. The first step of this lazy framework is identifying deep value recovery candidates, which means you are looking exclusively for established businesses that have been absolutely obliterated by 70% or more during the market-wide panic. You are not looking for speculative, unprofitable tech startups that rely on cheap debt to survive. You are looking for foundational companies with massive cash reserves that are temporarily trading at absurd prices due to indiscriminate index fund liquidations. The second step is ensuring the business is fully aligned with long-term secular tailwinds, meaning the enterprise is riding a powerful macroeconomic trend that will last for the next 10 to 15 years regardless of short-term cyclical recessions. Whether that trend is the complete modernization of domestic electrical infrastructure, the rising global demand for critical industrial metals, or the permanent digitization of enterprise logistics, the underlying business must be structurally guaranteed to grow over the long decade. The third step is focusing heavily on industries that are fundamentally too big to fail, because modern political structures and central banking institutions will always step in to inject massive liquidity to protect critical domestic infrastructure, financial institutions, defense contractors, domestic energy grids, and major transportation networks will always receive indirect or direct sovereign support during a severe crisis, making their ultimate survival and recovery a statistical near certainty. The fourth and final step of the lazy framework is positioning yourself directly inside the global commodity and materials production cycle. Because any post-crash economic recovery requires an immense volume of physical inputs like copper, steel, and energy, companies that actually own the physical ground, the mines, and the production facilities are the ultimate hedge against long-term monetary debasement, and their stock prices historically experience massive multi-bagger expansions during the recovery phase. However, you have to be incredibly careful to avoid the classic value traps, which are poorly managed, structurally decaying businesses that look incredibly cheap on a screen but are actually headed toward permanent economic obsolescence. A business like a legacy payment processor or an overhyped pandemic fitness brand might look like a massive bargain when it is down 80%. But if the underlying structural moat has been permanently destroyed, it will simply continue to bleed down to zero. This is exactly why you must utilize objective automated scoring systems to filter for strict operational quality and balance sheet strength long before the actual market volatility begins. So your watch list is completely finalized in advance. The absolute worst time to start researching companies and building an investment watch list is when the market is actively crashing 30% and your portfolio is in the red, because your brain will be flooded with cortisol and you will make an emotional decision. You want to have your exact buy targets and your automated accumulation rules set up completely in advance, while the sky is perfectly blue and the market is completely calm, allowing you to execute like a machine. I personally do not believe in holding massive piles of unproductive cash for years, while inflation eats away your purchasing power, because trying to sit on cash while waiting for a crash is just another complex form of active market timing. The far superior, incredibly lazy approach is to maintain an aggressively high personal cash flow from multiple distinct income streams and consistently automate your investments every single 2 weeks into broad index funds. Without fail, when the inevitable macro correction finally arrives, you simply tilt your excess monthly cash flow directly into your pre-selected high-quality value targets, effortlessly accumulating cheap shares while the retail crowd is freezing in terror. The exact same automated discipline must be applied to taking profits, because there is absolutely no point in generating a massive 5 times or 10 times return on a distressed asset if you are just going to round-trip the entire investment back to zero. The retail crowd gets incredibly greedy at the top of a cycle, convincing themselves that this time is permanently different and that a cyclical stock will somehow continue growing linearly into outer space forever. A disciplined investor knows there is absolutely no sin in taking your profits when an asset hits its predetermined valuation targets, locking in your financial freedom, and letting the Wall Street insiders fight over the remaining scraps. Looking forward into the immediate calendar year, we have massive geopolitical and macroeconomic catalysts on the horizon, including critical international energy summits and highly anticipated monetary policy decisions regarding baseline interest rates. The entire mainstream market is desperately praying for an immediate regime of aggressive rate cuts to sustain the current asset bubble. But the structural reality of persistent core inflation makes that an incredibly dangerous assumption. If the central banking system is forced to maintain elevated interest rates or even subtly hint at further tightening to combat rising producer inputs, the highly leveraged sectors of the stock market are going to experience an incredibly rude awakening. You do not need to panic about these upcoming macroeconomic events. Because as long as your framework is entirely rule-based and your lifestyle is fully detached from the daily financial matrix, market volatility is your absolute best friend. The ultimate goal of building wealth is not to spend 40 hours a week analyzing complex balance sheets, reading financial news alerts, and stressing over the daily movements of your brokerage account. The real goal is to establish a system so simple, so automated, and so intensely boring that it requires zero ongoing maintenance, allowing you to spend your actual life drinking coffee on a terrace without caring what the market does today. Stop falling for the institutional illusion that successful investing requires hyperactive trading, complex derivative strategies, and constant emotional stress, because that is exactly how they trick you into losing your capital. Build your watch list of high-quality businesses, automate your bi-weekly accumulation discipline, accept that periodic market crashes are an inevitable law of economic physics, and be completely prepared to profit from the panic when it arrives. The current fiscal trajectory of the sovereign state is completely unsustainable, and pretending that debt does not matter is a luxury reserved for politicians and financial commentators who do not have their own skin in the game. When the government is forced to pay more than 5% interest to finance its operations over a 30-year horizon, it creates a structural baseline that resets the pricing model for every mortgage, every corporate loan, and every equity option in existence. Most retail investors are completely oblivious to the mechanics of the fixed income market, assuming that bonds are just boring instruments for grandfathers, while completely missing the fact that the bond market is the absolute dictator of global asset valuations. If the sovereign interest rate establishes a permanent floor at these elevated levels, the era of free money is officially dead, and businesses that cannot generate real organic cash flow will be completely eradicated from the indices. The entire economic apparatus of the last 15 years was artificially inflated by 0% interest rates, creating a generation of investors who confuse a roaring bull market with personal financial intelligence. True intelligence in this game is not about predicting the future with absolute precision. It is about constructing a personal balance sheet that is entirely indifferent to whatever narrative Wall Street is trying to sell you on any given Tuesday, when you see headlines screaming about a systemic crisis or a sudden collapse in corporate earnings.